6 months ago, almost everyone on Wall Street was betting the Fed would cut rates this year. Now, they've flipped completely. Traders are pricing a roughly 70% chance of a rate hike before the end of 2026, and it all hinges on one meeting that wraps this Wednesday. Think about that. The same crowd that wanted cuts now fears a hike. There's a brand new Fed chair in the room. Inflation is still running hot at 4.2%, and a single decision is about to quietly reprice your savings, your mortgage, your bonds, and your stocks, all at once. Here's the wild part. The Fed might not even change the rate, and it could still move your money. In the next 10 minutes, you'll learn exactly what the Fed is about to do and what it actually means for the money in your pocket. No jargon, no hype, just the stuff that matters. Let's get you up to speed fast. No prior knowledge needed. The Federal Reserve is America's central bank. A committee inside it, called the FOMC, meets about 8 times a year. At each meeting, they decide what to do with one key interest rate. This week's meeting runs June 16th and 17th. The big announcement lands on the afternoon of June 17th. Why does one rate get this much attention? Because it's the base cost of money for the entire economy. When it moves, almost everything else moves with it. Most people watching markets expect the Fed to hold the rate steady. They expect no change. So, here's the twist. The drama this week is not the number. The drama is the story around it. 6 months ago, the plan was rate cuts. Today, the conversation has swung all the way to a possible hike. That is a massive mood swing in a very short time. And this is also the first meeting for a new person in charge. So this week, markets get 2 things at once: a fresh rate decision and a first read on a brand new boss. That's a rare combination. It's why traders are glued to their screens. Now let's walk through the numbers, one at a time. The Fed's current target sits at 3.50 to 3.75%. That range has been held steady through back-to-back meetings this year. Inflation, measured by the Consumer Price Index, rose 4.2% over the past year. That is more than double the Fed's 2% goal. The job market is still strong. The economy added 172,000 jobs in May. That was roughly double what forecasters expected. The unemployment rate held steady at 4.3%. That's the 3rd straight month at that level. After that hot jobs report, bond yields rose and stocks slipped. Traders quickly repriced their bets. And here's the headline figure. Market-implied odds of a rate hike by the end of the year jumped to about 70%. 6 months ago, those same markets expected cuts. Let that sink in for a second. That's not a small adjustment. That's a full reversal. So pause and stack these up. Sticky inflation at 4.2%. A hot labor market adding 172,000 jobs. And hike odds near 70%. Each number alone is interesting. Together, they tell a story. The story is higher for longer. That's the phrase you'll keep hearing this week. Okay, but why should you care? Here's where it hits your wallet. This one meeting quietly moves several things at the same time. First, your savings. When rates stay higher for longer, savings accounts, money market funds, and CDs tend to pay better yields. That's good news for savers. Second, your borrowing. Higher rates keep the cost of money expensive. Credit card interest, auto loans, and general borrowing stay elevated. Third, your bonds. Bond prices and rate expectations move together. A surprise toward higher rates can ding the value of existing bond funds. Fourth, your stocks. Rate-sensitive growth stocks often wobble when the story shifts from cuts to maybe hikes. Now, here's the catch. These forces don't all pull the same way. Higher rates can reward your savings while squeezing your loans. They can lift your interest income while pressuring your stocks. So the same decision can feel good and bad at the same time. It depends on which side of your balance sheet you're looking at. A saver and a borrower can watch the very same announcement and walk away with opposite feelings. So a meeting that ends with no change to the rate can still reshape your savings account, your loan payments, and your portfolio. That's the part most headlines miss. Let's slow down and build the foundation. What is this rate really? The Fed funds rate is the interest rate banks charge each other for overnight loans. The Fed sets a target range, now 3.50 to 3.75%, and steers the actual rate to stay inside it. Think of it as the base cost of money. It ripples out into almost every loan in the economy. When the Fed raises rates, it cools borrowing and spending to fight inflation. When it cuts, money gets cheaper to support growth and jobs. Now, what's a dot plot? 4 times a year, the Fed publishes something called the Summary of Economic Projections. The dot plot is part of it. It's an anonymous chart where each policymaker marks where they expect rates to go in the coming years. It's a window into the Fed's collective thinking. It is not a promise. This week's meeting ships a fresh one. And here's the new character. His name is Kevin Warsh. He's the 17th chair of the Federal Reserve, sworn in on May 22nd. So this is his very first meeting running the show. Warsh was a Fed governor before, from 2006 to 2011. Many expected him to lean toward lower rates, but sticky inflation and a strong job market have pushed in the other direction. The Fed ran a cutting cycle into late 2025, then paused and has been holding steady ever since. So picture the path. Cuts late last year, then a pause, then hold after hold this year, and now a new chair inheriting that exact moment. One more thing worth knowing. The FOMC has a dual mandate: stable prices, around 2% inflation, and maximum employment. Right now, those two goals are in tension. Inflation says, be careful. The job market says, the economy can take it. That tension is the whole debate in one sentence. Now, before you panic or celebrate, here's what the skeptics are saying. Take a breath, because the picture is more nuanced than the headlines. First point, the Fed does not directly set your mortgage. Long-term and 30-year mortgage rates track the bond market, especially the 10-year Treasury. They can even move opposite to the Fed funds rate. The Fed's main lever is short-term rates, not the loan on your house. Second point, markets often misprice the decision. That 70% hike figure swings with every new data point. It is frequently wrong. Today's odds are a snapshot, not a forecast. Third point, one meeting rarely changes the long-run picture. A single hold or a single hike seldom alters a diversified investor's decade-long outcome. The data suggests time in the market tends to matter more than any one Fed day. So the noise this week may feel huge. The long-run signal is usually much smaller. In other words, don't let one afternoon rewrite your whole plan. The headlines are loud. The actual impact on a long-term investor is often quiet. That gap between noise and signal is where a lot of people get tripped up. So what should you actually watch on Wednesday? Analysts frame a few realistic scenarios. Remember, nobody knows the outcome for sure. Scenario 1 is a hold with a hawkish tone. If the dot plot drifts higher and the Fed signals fewer cuts, then markets might read that as a warning, and rate-sensitive stocks and bonds could feel pressure. Scenario 2 is a hold with a dovish tone. If Warsh reassures markets that cuts are still on the table, then markets might breathe a sigh of relief and risk assets could catch a bid. Scenario 3 is a genuine surprise in either direction. If the Fed moves or signals something unexpected, then volatility could spike as traders scramble to reprice. Notice the pattern. In all three, the wording matters as much as the rate. That's why traders will obsess over Warsh's very first press conference. They want a read on how he handles sticky inflation, a hot job market, and disagreement inside the room. So here's the one-sentence recap. The Fed is widely expected to hold at 3.50 to 3.75%, but the tone, the dot plot, and a brand new chair could quietly reshape your savings, loans, bonds, and stocks. None of this is financial advice. Always do your own research. If you found this helpful, subscribe to Stock Desk Daily for clear, no-hype market coverage every single day. We break down the headlines that move your money, one short video at a time. Thanks for watching, and we'll see you at the next one.